Today on the show, we're talking about retiring, but when you have a business. Now, I'm with Martin McGrath from Financial Edge Group. Martin, realistically, and this is, things are like whether you've got your own business and self-employed or you work at Woolworths down the road as an employee, there are some things that are just the same.
Yep.
Like we've got income into the family, we've got expenses, might have some superannuation,
House, got a mortgage, got
might
super.
have some investments. Yeah. So whether you're self-employed or not, there's a lot of things that look the same.
80% is probably the same.
Yeah. Now, this case study that we're doing today is retiring when you have a business. And I think we'll probably say it's more of a complex type case study.
Yep.
So we'll feed the wolves who want something a little bit more juicy, or if you've got a big business. But I would say if you don't have these levels of assets or income, you should still be able to learn something because some of the concepts should stay the same.
100%. The pension stuff, the contributions, the non-concessional contributions, those kind of things. And also potentially leading to either having a business, have sold a business, and or some of the structures or strategies we're going to talk about today would also apply if you have wealth or significant wealth.
I was literally about to say you could, for the purpose of this, supplement the business, quote unquote, to property portfolio, to equities, to a trust that's been inherited, funds from a trust. So this is our second case study we're doing. There's another one next week about someone who is retiring with multiple properties.
With, significant property portfolio.
The last episode we did just everyday simple affairs type thing. This is retiring when you own a business. Next week or next episode in our feed will be when you are retiring.
Property portfolio, and what do I do and how do I turn that equity into actually cash flow in retirement.
So there you go. We will talk about it. My name is Glen James, joined by Martin McGrath. Let's do a show about retirement called Retire Right.
Perfect.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
Okay, like last episode and sometimes on the show here, there is a presentation to accompany this.
We've done some homework. We've prepared.
We are. Yeah. You know, the 3 Ps or the 5 Ps. When you watch this on YouTube, it'll be evident. You'll see the slides. We do acknowledge we've got a large audience who listen only on Apple or Spotify. We acknowledge you and you will not get left behind. Some of the visuals that are I don't think there is actually visuals.
No visual graphs. It's just some numbers.
Just some numbers and tables. So you should be able to hang in there. And if you do want to recap when you get home, you can pull up YouTube and do that. Just search Retire Right Australia, Glen James, Martin McGrath on YouTube, and it should come up. Okay, retiring when you own a business. It's a case study. Current situation. Who have you got here?
So there's some clients that we helped in the last 12 months. We obviously anonymized them, if that's a word. So client 65 recently sold their business, ready to retire. They kind of came and saw us a few months before the business was on the market, about to be sold, and they accepted an offer. We're just trying to figure out how does this all fit together, and we've got a great accountant that's helping us, but we know there's some other moving parts we need to help with. So they had about $1 million in super each. So decent wealth being created outside of the business already. And the business proceeds were going to be around $2.5 million after tax, but in a company structure. And we're not going to get too nerdy, but they weren't selling their company. They were selling their business that was within the company. What that meant was it wasn't their money. It was their company's money. And there were some ways to get that money out. I suppose some options about getting that money out, which is part of what we'll talk through today. And that's going to be about $2.5 million in the company. And as mentioned, they were ready to retire and they wanted to live on about $150,000 a year. So nice going retirement.
After
They deserved
tax.
it. After tax, no mortgage repayments anymore. So 150 grand a year, about $3,000 a week or so.
28.84.
Yeah. So, and that was made up of maybe about $100,000 a year in, I don't know, eating out, groceries, those kind of things. They had some big travel and trips planned along the way. That's what they wanted to make sure that cash flow could set up for them.
Should be able to survive on $3,000 a week after tax.
Yeah, I think I would be able to.
Yeah.
Most weeks at least.
Sometimes it's
See.
hard.
Yeah.
But
Now, we started getting some the nerdy stuff here and I touched on a little bit there as it was the company's money. Because of some ways and some small business concessions and bits and pieces, they could get around $500,000 out of the company tax-free, but the rest had to be either stay in the company or come out as either retained earnings or dividends of the company. So
Right.
that's important. And that's, I suppose, where some of this complexity or value from the strategy starts to fit together.
okay, so I just want to potentially put some concrete examples in here. Can we make an assumption of the type of company?
Yeah, it was a proprietary limited company.
Oh, so like what was the business?
Um,
Wall and floor tile supplier.
sure.
Okay.
Yep.
So they've got a company, proprietary limited,
Yep.
called Good Floors, proprietary limited.
Yep.
They had the showroom that they
Yep.
rented.
Yep.
We'll assume that. We'll assume that customers came in, they sold floor and wall tiles.
Had some employees.
and had some employees. They a lot of the installation was contractor and business 101, sell something for more than what you paid for it.
Yep.
Pay some expenses equals profit. So you're saying that proprietary limited company, and this is another kind of, and I just want to spend a bit of time here to kind of help explain this. When you sell a business, if it's a complete exit, more times than not, they're not going to buy the shares off you and actually take over your vehicle.
Correct, yeah.
They are going to potentially just buy the name, take over the lease in a new
customers and everything, yep.
So that same wall and floor tile shop, next month, new owners, looks like the same shop, but in the background, it could be called
New ABN,
Mary
new
and
holding.
David's Flooring,
Flooring, yep.
Proprietary Limited. So that's kind of how that works.
Yep.
So based on this, when they sold the company, who owned the shares in the actual proprietary limited company themselves?
They had it. In some cases, you could or should have a family trust. They
I was
didn't.
going to say, because there's a few red flags here that should have been addressed 25 years ago.
Correct.
Okay.
So, yes, that was just a simple, we're not going to be successful. Let's set up simple and save a bit of money. And, yeah, it was close to 30 years they'd run it.
Yeah.
And so, 50-50 shareholders, mum and dad in the business, and they stayed as the shareholders because they kept the company, but the business left the company, and all of a sudden the business no longer traded and had employees. What it had was $2.5 million in the bank.
So because mum and dad, we'll just call it 100 shares in the company, each owned 50 shares.
Yep.
When the new buyer came in, because the buyer didn't take over the 100 shares, they just lopped $2 million, $2.5 million into the company because they bought the goodwill, the IP, potentially floor stock off the company.
Yep.
And then set up their own entities.
Correct.
Awesome.
Correct.
So, but just on that, because I think it's really important for if you're younger and listening and want to go and start a company and whatnot, there's some potential issues here, and that's why you need to spend the money when you first start to get it right. And I mean, they're not whinging, they've done well, but traditionally you would likely want a family trust
Some more flexibility in
to
the shareholders.
own the shares.
Yeah, agreed. Yeah,
agreed. And we might actually, let's do an episode next time you're in Newcastle with trust structures for business.
Yep, trust, yep. And that's a key point. That same company we're
or
talking
even
about
they could have operated out of a unit trust.
could have been a sole trader, could have been
Yeah.
a family trust, could have been a unit trust, could have been a joint venture, could have been a partnership. So the advice would be very different. If they, and or as mentioned, as a company, if the person bought the actual company and bought the shares off them, the outcome would also be different. But, so yes, the structure is important, getting it set up initially is key. If you even if it's not, I know you might be on the train tracks. Maybe it's better off to get off and stop too and change it. Again, obviously the business end up being worth like $2.5 million after cost. They might have been able to change the share ownership when it was worth 300 or 400 grand, but gone, 10 grand in tax, nah, we're not pay that.
500 grand tax in a few years.
All of a sudden, 10 or 20 years later, it's worth a lot more.
But there are some, and we won't get into it now, there can be some restructuring exemptions.
Yep.
Both state and federal.
Yep.
With
some
stamp duty
rollover
and
relief
whatnot and all
things.
that.
Yeah.
But that's why I just wanted to kind of, put a bit of masking tape around this box and paint around it for a little bit because it's really important. Because ultimately, if, for example, let's just play this out before we move on, what if they wanted to, quote unquote, keep going for another 20 years? So, we want to keep going, but we want to carve off half of the company. That could legitimately mean a new entity could buy 50 of those shares, which means there would be money falling on their personal tax return if they were to sell.
Yep.
Now, the reason that when you buy a company, you do not want to buy the company because you don't know what skeletons are in the closet.
Yeah.
And that was kind of my other question here. If there was was there any cash in the company?
There was a bit, there was a little bit of built up retained profits. They had some cash there.
Yeah.
And that was exactly that structuring side of going, well, you're paying yourself good wage. Again, they weren't my client at that time, but I understand how it happened. And well, you're paying good wages. Let's not pay a dividend out this year. If it had a family trust structure, they probably had adult kids that could have been used, another bucket company. There could have been other ways to
because you want to build wealth out of your operating entity.
Yeah, you don't want it in your trading entity.
Yeah. But we're here now. This is the case study. So let's now move on. Got current situation. Considerations, let's just touch on that. They've come for advice. Hey, knock, knock, Martin. We've got an entity here. There's 2.5 mil sitting in there. We're no longer active trading. We're 65. Help.
Yeah.
And I think we did mention, was there already, $1 million in super.
$1 million each in super.
Yeah.
So
was
$2
that
million.
a self-managed super fund or retail or industry funds?
Retail funds in accumulation phase, because they were accumulating and they potentially actually could. They were already 65. They could have been in pension phase, but they weren't, which is fine. And again, they've been putting in some maximum concessional contributions out of the company with some good advice from their accountant, but otherwise hadn't really put a lot of extra money in non-concessional or voluntary interest super for a while.
So they just wanted to get advice on the way forward.
Yeah, it was kind of go, well, I think they knew they could retire with some wealth there because, adding it all together, there's $4.5 million of wealth. I think they knew we can retire, but do we take it out of the company? Do we take it out of super? If we've got enough to live off here, do we not access our super for a while? Can we move more money into super? Are the investments working hard enough for us?
You know how I mentioned that, or you said like it's around 80% the same as, most people. It's just there's some different stuff. There's a common theme here in the case study we did last week with people that didn't need advice, quote unquote. If they'd seen an advisor 5 years earlier, they would have saved more money and it would have been a better structure. All that to say, I think if you are 55, it's probably a good time to potentially knock on the door of an advisor, have a chat. Come back in 3 years, we think and they would pretty much tell you. It's like, look, there's nothing, I think we're fine, come back in 3 years. But if you had a few moving parts like this and they knocked on your door at 55 with all this going on, you would have been like, right, tomorrow we're getting money out of this company. We're starting to
build some more money into super, dwindle down some of those retained
And that's
profits.
kind of why I wanted to do this podcast for those, not necessarily in age, over 50, 55s, but potentially within 10 years of your quote-unquote retirement age, whatever that looks like to you. So we'll move on. Strategies implemented. So how did you pluck this? And then later on, we will tell everyone how much Martin charged.
So there's a fair bit of moving parts in here, and I think we in fact tried to squeeze it all on one slide or two, so we'll dip into this. And again, some of the concepts here, we're not going to explain all the rules, but so what we initially did is we could get that $500,000 out of the company tax efficiently, and we used that money to go and move a whole bunch of money into super pretty quickly. So they had $2 million in super, we got them up to 2.5 pretty quick. And then we move them straight into account-based pension or income stream because they're over 65. They were retired anyway, and so we put them in pension phase. What that did is, it moved that $2.5 million into a 0% tax environment forever for them, and also it meant that they started to get an income stream. And we'll explain the company stuff in a second, but because there was a bit of unknown, what do we do with the company? When do we start doing things? But we're not going to get wages as of next month. How do we start paying ourselves? Well, we started to pull out $125,000 a year. I think they end up taking it monthly, so a bit over $10,000 per month, tax-free, and that was going to pay their bills for a fair while, rather than, do we take that money out of the company and put it in a bank account and live off it for a couple of years? No. Accelerate it into super, move into pension phase straight away and start to draw some money out of that.
Yeah, love it. Okay, so we've sucked some money out.
So then the other $2 million in the company, and we I suppose do have a nerdy calculation. So they had some, and this was a consideration, there was some discussions and calculations with myself, their accountant, themselves around, do we shut down this company and what's that going to cost us versus do we leave the money in there and what do we do with that? And we'll show and explain why that we agreed on the strategy we did. But the strategy we agreed upon was, let's not pay a bucket load of tax now. Let's leave it in the company, but let's not leave it in cash forever. Let's make it start to work a bit hard for us. So we actually invested that money inside of the company.
You can... You see my face, and this is what I was like, this is such a great example of forward planning not occurring because you'd never, as a rule of thumb, would want any type of investment in any type of trading company.
Yeah.
Because, and this is part of the reason why when people buy companies, they'll set up a new entity and structure.
To not have the...
Because there could be skeletons in the closet. Now, and again, you play the cards you're dealt. And we're not saying this is bad advice. It is the right advice for exactly their situation. Yeah. But what if 3 years down the track, someone calls, hey, you sold us of these floor tiles. We slipped over. The tiles you sold us, we're suing your ass.
Yeah.
And guess who they sue? The company who sold that
still exists.
That still exists today.
Yeah.
Oh, that company's got $2 million in there.
Yeah.
So you can use a company as a trading entity and as an investment vehicle only.
100%.
Generally speaking, you don't want to shat where you eat. Sometimes it's inevitable.
Yeah, and then there's a whole other tangent is that there's two ways to solve that. Again, if they, in this case, the type, we made up this flooring company, they weren't a flooring company, that their potential runoff risk was very, very low, but that's definitely a consideration.
Yes. Okay, so you've got a brain.
Yes. So that was considered.
That's good.
That was good.
Yeah.
But at that point, it may be a very different answer to a very different
But if it was
kind
in a
of
high
individual.
litigious environment, it could be worth, we need to bloody
Close
get this
these
cash out,
doors
liquidate
and-
the company and close the company.
Correct.
All legal, all ethical, but it's just we need to put a full stop here.
100%. So that was a consideration. In this scenario, very little to no risk in that case, but definitely in lots of others the answer would be different. If it is in others like that, a way to still get the benefits of this strategy with the right structure initially is you have your trading company, the shares in that are owned by a family trust. That family trust has attached to it a holding or a bucket company. Therefore, you can flow those dividends out of your trading entity through to another company tax rate and protect those assets, move them across.
When you say bucket company, so with a trust, there will be beneficiaries, so the husband and the wife in this case.
Family members, etc.
Family members, charities, whatever.
Yep.
You can list the company as a beneficiary of that trust. Trusts don't pay tax. The beneficiaries pay tax at their tax rate.
Yes.
So if the company received $100,000 as an investment company, the tax rate for the investment company
would be 30%, unless there are some exemptions if you can get
like a 10% or something. Yeah.
Yeah, you can get it down to 25, but typically 30.
But 30 is a lot less than 49.
47,
47.
including Medicare levy. And that 30, if it's coming from another company, you get the other company's franking credits.
It flows through.
Flows
through the trust.
Through the trust. So worst case, you might have to pay an extra 5% if your trading entity's at 25 and your investment company's at 30. In some cases, your trading company might be at 30 and your investment company's 30, so you're not paying any extra at all. Or in some cases, they're both at 25. But in most common, your trading entity might be 25% tax rate, your holding company might be 30%.
Now,
but that's still better than 47% elsewhere.
And now we kind of burying the lead of this case study, but I just want to go there. When we have flow through to a bucket company, the bucket company pays the 30% tax.
Yep.
We'll assume that it's 30% because you might be thinking at home, oh, I've got a company that I do jib rocking with and the company tax rate's 25. Is it 27? 25?
25.
Yeah, 25. I only pay 25. Yeah, but there's exemptions for, is it under 50 mil turnover?
Yeah,
or
small business.
Anyway, so, but if that company pays that tax 30%, at some stage, we need to get that money out if you want to go on holidays.
Yep.
So it has to pay a dividend to
an ultimate beneficiary, which is probably back to you as an individual.
Yeah.
Yep. And
So,
you can have a family trust under that as well.
so two family trusts.
Yeah.
Yeah. It just gets convoluted.
The accountants like it, but
I bet they do.
There-
They charge sets of fees.
there's as long as there's the benefits outweigh the costs, like many things in life,
Yeah.
then it's money well
Whether
spent.
it's Panadol,
Yeah. Financial planning advice, accounting fees.
COVID vax.
Yeah.
All right, cool. Okay, let's now go back to the cricket.
So, yes, $2 million in the company, we invested that.
Yep.
Again, many situations where you definitely wouldn't. We invested that into more than cash, but not a higher risk
So
portfolio.
you just set a wrap account up owned by the company or something.
Exactly.
Yeah, okay.
Yeah. We invest that in what we would call a 60-40 portfolio, 60% growth assets, 40% in defensive. And we set it up so that company was going to pay out $120,000 per annum as a dividend to each of the shareholders.
Fully franked,
Fully franked.
which means the tax had already been taken out.
The 30%, the 30% has been paid, which is we'll show you those kind of impacts in a second.
Yep.
Do they need that cash? No, and we'll show them what we did with that cash. But there's a reason why that number was picked. We could have left it all in there, but we still want to get the money out of company. Exactly to your point. One day we don't want to leave it there forever.
The chickens always come home to roost and they need to.
It's a question about how fast we accelerate that.
Yep.
Point 3, we set up, in this case, both the super funds. They didn't have an SMSF. They had separate super funds and the company portfolios on a wrap account.
Yep.
The client's wealth, the client's investment preferences, they wanted to have some direct holdings, they wanted to have some ETFs, they wanted to see some term deposits, all those kind of things and they wanted to be able to log on and see it all in one place.
Yeah, and that's the thing, like when people are having an aneurysm at the moment because we're talking about wrap accounts, one, you'd use a wrap account for the investment to manage it. You can't use your industry super fund as an investment account.
Yeah, you could not have a...
You know, it blows my mind why these big super funds don't create investment arms. Why wouldn't anyway?
Yeah.
Why wouldn't they? So you got to actually have an account to manage this.
Yeah.
And if you had a wrap account for the ordinary money that's owned by the company, if you had a wrap account in the super entity, you could log in, see each company's portfolio on the one screen.
Yep.
You'd probably get aggregate fee benefits across the parties.
The product we used, once you have more than $1.5 million in your family group, you don't pay any extra in fees.
Love it.
So they were there very quickly.
Who was that? Net Wealth?
It was not Net Wealth. It was another provider in the marketplace.
Are you
In
gonna
this
say?
case, BT Panorama. Which is owned by Westpac Bank. And there are others that obviously have pros and cons and benefits, etc. In this case, the functionality of it all, the client portal, the advisor portal, and then the fees.
And this is the thing, like people have a freak out, and usually we freak out when we don't fully understand and a lack of education. And that's just, we get worried and scared when we don't understand things. Sure, BT Panorama, owned by Westpac, it does not mean your super or investments is with BT and Westpac. It's just the structure. You log in, you can buy CBA shares on that platform.
Has that fund done well or not? Well, you could have it all in term deposits. You could all have it in one stock. You could have it in an international managed fund. You could have it in international shares if you wanted to. So the platform or the wrap structure allows you to be as diverse with your holdings as you wish and want.
Absolutely. And then you've got here, they're making a 30K personal concessional contribution each until age 67.
Yes. So even though they are retired, the dividends that will come through are going to be taxable to them, which again we'll show in a second. And they can still claim a deduction against that. They don't need to meet a work test because they're under the age of 67 and there's tax to be saved.
And I'm now showing my lack of being in the game, but you wouldn't do a South Sack through the company because you'd want to wind up, you don't want to have to pay workers' compensation. Because if you're paying a salary sacrifice from the company, it's got to be attached to an employee.
It's a wage, and
it's a wage.
No genuine wage,
so that would just
Which is, again, a good point. How can you get money from companies? You can get it as an employee or you can get it as a dividend. You can get it as a director's loan, but I won't go too far down that path. So, and again, advice to this client or other clients that we help like this of going, well, you want to take 300 grand a year out of your company. Don't take a 300 grand wage perhaps. Take 150 grand wage and take 150 grand as a dividend. You still end up with the same 300.
Why?
But there will be different, as you mentioned, workers' comp implications and extra insurances on your wage. You don't pay workers' comp on a dividend. Your super guarantee or your SG of 12% is not on a dividend. It is on your wage. If you take wages, you have to withhold PAYG withholding tax. There is no PAYG withholding tax on a dividend. The dividend you can ramp up or ramp down whenever you want, whereas wages are declared single-touch payroll every time you take a wage, whereas the dividend you might decide at the end of the year, let's take an extra 50 grand.
But this is the problem. If, I'll just use some round numbers, if someone wanted to take 500 a year out of their company, if they did 300 throughout the year as an employee, their super would be capped. It's fine. They're paying highest marginal tax rate. Now, at the end of the year, they're like, oh, crap, we probably should have paid some franked dividends. So we're paying 30% on the money coming to us effectively, not 47. And you can't unpluck the payroll chicken once it's been paid and lodged. The tax is withheld. So yes, you are self-employed. Yes, you do own the company, whether it's your family trust or you personally. But yes, you actually are just an employee of your own company, like your staff. So, and that's what in my business, I just do a nominal, I think up to the,
what a certain threshold for your
wage. And then at the end of the year or quarter or every 6 months, I'm like, oh, I need cash. Talk to the accountant. Pay a dividend. So, it's just this is a more complex episode, guys, and that's fine. But do you want to move on to
back to that slide. Why could we do 30? Because, as I mentioned, the dividend doesn't come with a super guarantee. So they had no personal wages. Again, for simplicity, we've assumed the business is sold in June and we start this trade on the 1st of July. They've got no wages, so they can do the whole 30. If they were getting a 40 grand wage or 120 grand wage plus a top up,
they wouldn't have had catch up spare.
Super balances were too big at $1 million each, and then they had
because they've got to be under 500.
Under 500 to do catch ups. We then recommended an additional. So they did the $30,000 personal concessional. We were doing an additional $80,000 personal non-concessional each to super. Every year until all the company funds are dispersed. The goal is that we do want this money to run out in the company, but we want it to run out over a period of years, not all in one amount, which again lines it up. If they wanted to spend more in retirement, they could spend more, but we also don't want them to build up with extra personal cash. So we are going to start to load some extra money into super.
So this, for example, and this is actually quite unique that there is so much, the trading entity is moving to basically an investment vehicle for the next 10 years or however long it is. There would be some hop, skipping and jumping because you want to line it up so it's like, okay, all the accounts receivables in, Have we collected all the money? Okay, then at the end of this quarter, when our money's collected, we'll turn GST off.
Yep.
At the end of the financial year, we might turn
Cancel workers' comp,
PAYG
withholding. And,
so there is a bit of dancing involved.
Yep.
Where if there was wealth that if it was a unit trust entity and wealth just flowed out and invested in investment properties or whatever, you'd pretty much just like, I'll just leave it all, and then in June we'll just turn everything off.
Yeah.
So
yeah. And again, there's lots of complexity with this. We've simplified it for today, and we're already going into lots of nerdy things anyways. But yes, there's some more complications things to consider. And even to that point, they have a great accountant. So we worked closely with their accountant. It wasn't stepping on toes. It wasn't us versus the accountant, as the accountant was great at the accounting things. But we were there to be the big picture overall planning, make sure the investments were working hard, make sure their goals were met, weighing up the pros and the cons. Now, some financial advisors can help with this. Some don't. They don't have the expertise to work in this area. But my background actually is as an accountant, believe it or not.
I believe it. Yeah.
I sometimes look
dry
up
as a friggin' desert. Have to throw a bucket of water over the other side of the desk
just to warm me up. So, but we enjoy this kind of complexity, and we can see there's some value there. So, it's about, again, we didn't say, the accountant's got to go because we can do all this. We work closely with the accountant and make sure we match
same
the
lanes
strategy.
and speaking to each other. And sometimes you'll likely sprinkle in a lawyer if we need to look at some estate planning stuff.
Yeah.
Because remember, super companies don't automatically form part of an estate.
Correct.
This would, because they individually own the shares, but there can be some moving parts.
And evident to this, I don't need a financial advisor, I've got a good accountant. Yeah, but not really. There's the accountants aren't allowed legally to do some of the advice that we've done as part of this, but also it's not their job to forward plan and calculate your super contributions and your pensions and all those kind of future planning elements.
And we need to
part of an accountant's scope.
And just on that, I will make it clear. You said pensions. We're not talking about Centrelink age pension. We're talking about superannuation pension.
Account-based pension.
These
correct,
people left the Centrelink chat many years ago with their asset base. Finally, on this strategy slide, I've just put a box there over it all, mainly because I ran out of room for the tick boxes. So a bit of razzle-dazzle.
Yeah, the longer-term strategy for these, and they're going to hit the cap before they hit the age of 75. So that money coming out, we're going to load that into super every year. Now, they're at 2.5. They can keep building assets inside of super up until the age of 75 or until they reach $2 million each or $4 million combined. It's not a problem about having the wealth. They've got the wealth. They've got two issues around. One, it's the company's wealth at the moment. It's not theirs, and we don't want to rip it all out straight away. But then two, they don't have the caps. We're already using a bit of the bring forwards. We can only do $120,000 a year otherwise. So we will get the wealth into super. They've got 10 years to do so, and that's kind of going to be that end goal, is to get them the money out of the company into super, into tax-free. They will likely have some extra wealth that'll probably sit in their personal names when we shut down the company at some point. Yeah.
So that's the strategies that we implemented. Let's have a look at some actual outcomes of the advice. There you go.
So between the minimum pension of $125,000 and the dividends each of $120,000.
The minimum pensions, their own account-based pension.
Correct, yep.
Not
Centrelink pension.
Okay.
So they've got 2.5 million super. They need to take 5%. So that's $125,000 they're going to get per annum tax-free. On top of that, we're taking $120,000 dividend each per annum. That totals $365,000. There's no tax to pay on the account-based pensions. And the way the dividend level we've picked and the strategy we've picked has meant that the franking credits on those dividends, there is also no personal tax bills to pay on that.
Love that.
Yeah, good strategy.
What else?
The $4.5 million now is invested appropriately. So the money in super is invested for the long term. That one's actually invested a bit higher growth. It's about 80% growth, 20% defensive. The company's a bit more balanced at 60-40, and that's on purpose. You might have different risk allocations for different pots of money. Yes, pension and they're living off it, but they're only going to take the minimum pension for a long time.
Yeah, so, okay, just so the company, because that money is going to be fed out each year, we don't want a 80% growth because we need to deplete that sooner than later.
Yeah, again, personal advice, personal opinions based upon the client's expectation and you as an advisor. But the super funds, we're only taking out 5% a year. The company, we're taking around 240,000 out of a pot worth 2 million. So we're taking 12% out a year, if you look at it like that.
Yeah.
Again, some people are like, oh, just go high growth anyway, it doesn't matter. But the preference of the advice was, well, if we're going to take a high portion out, let's have a higher portion in more defensive allocation. Again, connecting to last week's case study, the 120 we're taking out each is coming out of the defensive side of the portfolio. We're moving money out of the cash bucket every month for the dividends, not out of the growth bucket.
Yeah, and the wrap account allows
us to identify
so much
that.
flexibility. Yeah.
And then the dividends being paid or top up the cash, we will need to rebalance that over time.
Yeah.
But this is how we set this up on day one.
Oh, what type of portfolio in the account-based pension? Do you remember off the top of your head? It was just a ETF portfolio? Or?
Yeah, ETFs, direct shares.
Yeah, right.
Yeah.
You do a bit of direct shares, do you?
Yeah.
Yeah, okay.
Yeah.
Do you do model portfolio of direct shares?
Yeah, so we work with a provider who manages that more on a day-to-day basis than us. But we like the transparency. You can touch and feel, well, I know that.
But particularly
I know
with
that brand, I know that bank.
with significant wealth with a pension account, direct equities can actually make a lot of sense.
Yeah.
But they're in conjunction and in concert with potentially a broader portfolio.
Yeah. Yeah, and still exposure to Aussie and international.
Yeah.
There's a bit of property exposure. There's a bit of gold exposure in this portfolio. So
these people are getting tax refunds each year.
yeah,
So they're getting $7,600 each per
tax
year.
refunds.
Why?
How much PAYG are they paying? None. How many tax installments are they paying? None. Why? When they get that dividend from the company, they're getting 120 grand's worth of cash, and they haven't paid $1 in tax. They're getting what's called a franking credit or an imputation credit for the tax the company has previously paid. That has to go in their tax return. They then are going to claim the $30,000 concessional against that. Therefore, their taxable income is a lower amount. Even though they haven't paid any tax, the credits they're getting are at 30%. Their average tax rate is going to be below 30%.
So just on that, whether you own shares in ASX 200 company, CBA, Telstra, any of those companies who pay dividend that's fully franked, that's had the 30% off, there's no different to that scenario with you've got your own proprietary limited company that pays a dividend. It's the same thing.
Correct.
And you might remember years ago, the government, Bill Shorten's government, they tried to change it so these franked dividends, it would only offset tax paid, not going to
be refundable.
Not a physical refund.
Yeah.
So that's why they're getting a tax return because they're receiving fully
back.
franked dividend
Yeah.
that has the tax already paid. And it was to stop double taxation, I think, back in the day. But
has this tax ever gone to the government? Yes. The company has paid it over its 20 or 30 years of trading. So therefore, when you get it as an individual, as a shareholder, you get that credit. Now, because we've decided to pick the certain level of dividend we're picking, again, good management or good luck together, we've picked that level so that they're getting a fairly friendly tax outcome for themselves. We could have picked a much lower dividend and they would have got a lot more franking credits back. Or we'll show an example. They could have gone, nah, let's shut the company down straight away, and they would not get any tax credits back. They'd have a big tax bill to pay.
yeah. So just on that,
if they said, oh, this is all too complicated, we don't want to pay some financial planning fees and accounting fees, let's just shut the company down
and move on with our life.
rip that $2 million out and put that in a bank account or buy an investment property instead, they would have had a final dividend, wrap up the company, and they would have paid $490,000 in tax. That's after allowing for the franking credits.
Yes.
So your $2 million turns into $1.5 million pretty quick.
And this is the trade-off with the non-litigious operation of the company. We want to save this tax
Yeah.
because the whole thing is do we want the looming chance of getting sued over our head for the next 10 years?
It may be better to.
Hell no, I'd rather pay $490 now
I'll keep
than
80%.
$3 million later and go bankrupt.
Correct.
Yeah. So that was the trade-off call.
Yeah, this does not apply in every situation, but it applies well in this client situation.
Yeah. And then obviously your last point here, over the next 20 to 30 years, this money's just going to keep going to town.
Yeah, and we encourage them to spend more than $150,000 because as the minimum pensions are going to go up every year, we're going to load more money into super. They're getting $365, which they don't need, so that's why it's loading contributions back into super. But there'll be a point where we can't, at the age of 75, we just can't get any more in.
Yeah, so just on the super Division 296, which is the extra tax over $3 million, now it's going to be a threshold change over 10 million.
Yep,
it will be 40%.
Yeah.
And then over 4 to...
So 3 to 10.
3 to 10 is 30.
Yeah.
And over 10 is 40.
40 total. Just on your income and your realised gains, not on your unrealised now.
That's right. Now, your strategies, you obviously do the best that you can at the time. When things change, you'll just have to adapt this as we go.
Yep.
And play the cards as they fall.
As they go.
Yeah.
Now, in this case, they have $1 million each, or by the time we implement a strategy, that 1.3 each, they will get to $2 million each. So they'll still be likely below that threshold. But if they're only taking out 5 or 6% of their super and it's making 7 or 8 or 9, it will still keep growing. Plus, if they're adding in. But our projections, I don't think, show that they were going to get above that 3 mil. Particularly now that level is going to be indexed.
And that's it. You just kind of set things up and you can pivot where you need to. All right, let's have a look at the advice outcomes continued with a nice diagram or this chart. So just talk us through for those who are just watching.
Yeah, so this is the stuff I've already explained, but just to put some numbers together around that. So if we take out as an annual plan from the company, they take $120,000 of cash out. There's a $40,000 franking credit that has already been paid on that at a 30% tax credit at this threshold. Therefore, the total income they've got to report on their tax return is actually $160,000. By putting the $30,000 into super, they get to claim that back. Therefore, they only pay tax on $130,000.
Sounds good.
And as Glen knows off the top of his head, tax on $130,000 is $32,388, including their Medicare levy. So do they have to pay tax? Yeah, they've got to pay $32,000, but they actually get $40,000 worth of credits. So that's where the $7,600 refund comes from. And again, simplicity. They can claim some of our fees back and get a higher refund. If they had some donations, they could get more back as well.
Can't wait till we get to your fee department.
Oh, yeah,
this
there's some value in this one.
Yeah.
So that's how that strategy is going to work. Will it last forever? No, it'll last for about 10 years. And the company money ideally should be closing or running out. Past the age of 67, they probably won't do the $30,000 anymore unless they meet a work test. There may be some scopes in people's lives to meet that work test. But if not, the strategy still applies. They just might not get as big of a refund. On the right-hand side for anyone watching, but I'll explain it for anyone listening, if they just said, shut down the company, let's get rid of it, what would have to happen is they would each have to declare a $1 million dividend, $1 million each.
F that.
They get $300,000 of franking credits. That sounds good.
Absolutely.
That sounds like a lot of tax credits, $333,000.
Until it's not.
Still claim the 30. Why not?
Yeah, go for it.
You got a taxable income of 1.3. Tax of 1.3 is $580,000.
Delicious.
Less the 330 equals a $245,000 tax bill. Times that by 2 for a couple. That's where $490 comes from. And again, there are lifestyle situations. If they had a home loan that they wanted to clear and they just wanted it gone, they wanted to take away the risk, they didn't want to pay accounting fees because argue that they're still going to have some accounting fees for the next few years. That might be and just take you 1.5 and it's gone.
Or stagger it over a shorter period of
2 or 3,
time.
exactly, yeah. So that's 1 year. We're planning close to around 10 years. We might accelerate at the end. In this case, they don't need 1.5 in their own name.
Yeah.
Because we can't get into super.
Yeah.
So,
all right. So this slide.
This just confirmed those cash flows. So monthly dividend combined $240, account-based pension $125. They're going to get some tax refunds. So they're going to get with the refunds over a whole year, 370 grand come in. They want 150 to live off. They can fund all the other contributions and still be left with money in the bank. If they didn't want to do the contributions, they'd have 220 grand a year building up in their bank account.
Yeah.
But they'd end up paying personal tax on that, et cetera, et cetera.
You've just got to put the money where it fits.
Got to put it to work.
Yeah. We'll take a break. When we come back, I'm going to ask Martin how much he hit these people for. We'll be back
And I will
after
reveal.
this. He will reveal. We'll be back.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Okay, we're back. If you are watching this on YouTube and you've got 15 trucks of money and you're watching this in 2030, I dare say that this price ain't going to be the same. This is just a very recent case study as at 2025. But if you're watching this long term, the concepts are the same, but don't hold Martin to the price. So what did you charge them as the once-off fee?
Yeah. So we have an initial engagement for the first 3 months to map out what we can do, discuss some scenarios, options, etc. The cost for this client in particular was $17,400, including GST.
That's cheap.
That
You
was
need to increase your price, bro.
I think that was great value to them. Great peace of mind, tax savings straight away, a strategy mapped out for many years.
Yeah.
A lot of work to shuffle some stuff around. There was conversations with their accountant. There was 2 or 3 or 4 meetings with them and some phone calls, etc. And that was at fixed agreement for the first 3 months.
And this is the thing, like the last case study, it was a one and done, no ongoing. There are so many moving parts in this. They need hand-holding pretty much until they check out.
Yeah.
Or until, I don't know, at least, I don't know, like with so much things happening and wealth, it's a complex situation. And even though if that company was wound up, they're going to have a butt ton in super, a butt ton personally invested if they've got money building up.
The limits or the
They
thresholds
might
may
need
change.
some investment bonds in a couple of years, because what generally happens is you implement advice, go, yeah, we need 150 a year, sweet. 3 years later, no one's spending all their money. It's building up. What do we do with it? Okay, we need advice, maybe an investment bond or put it back into an investment account. Want to change homes and downsize, and we've got another, because someone like this, their house might be worth 2 or 3 million.
Yeah, it was. Yeah.
And they might go, all right, we're sick of this. We're moving up the coast, buying $1 million house. What do we do with the spare
cash,
$2 million? So use the downsizer to start with. But yeah, so the value of this is in the actual ongoing relationship.
100%.
So what did you charge them? Oh, and before we get to that once-off advice, you mentioned it before, it's tax deductible to the super fund and to them personally.
Yeah, a large portion. Tax deductible to what it relates to tax affairs.
Yeah.
Clearly, if hopefully people have listened for the last period of time, a lot of that was around tax planning, the company tax planning, personal tax planning, contribution to super. So the whole fee wasn't 100% tax deductible, but a large portion. I think in this case it was 70 to 80%. We have some guidelines about we have to proportion that around the advice and the time. And so we told the client initially, here's what the fee is going to look like.
Yeah.
When we go through this process, we'll tell you how much you can actually claim and send them a statement. You paid us a total of this amount in fees. This much can be claimed. And in this case, we took none of it from super. It was personal, I think a little bit out of the company.
Yeah, I mean, 20 grand or 17 and a half.
Yeah.
What are you doing here? There's millions of dollars floating around. All right, so now if we go to the ongoing arrangement, talks about this fee on the screen.
So after those 3 months were done, it could be, okay, well, yep, Martin, thanks for that. We know what we're going to do forever. Or, hey, we've got a lot of money and wealth here. We need to help someone hold our hand for a longer time and implement this. And every year we've got to shuffle it around, et cetera, et cetera. So our ongoing fee total is $28,600 per annum.
Yeah.
That's paid monthly. That is split in 3 ways. The company pays a decent chunk of it, around 60% of it. And then their super funds pay around 20% each out of the super funds.
Yeah.
all of that ongoing fee is tax deductible. Obviously, the company is the one that gets the highest tax deduction or tax rate in this case.
But I mean, like, with this flat fee and the wealth that they've got and all the, dickery that you will do throughout the year, it's actually a nominal amount in the scheme of things.
Yep.
And it's almost like good luck if you don't want to pay someone to do all this yourself.
Yeah.
You might be able to, like we've discussed.
Great and advanced DIY, sure.
But you've got bigger problems than 30 grand a year gross that's tax deductible.
Yeah.
And how often, and this is the thing, like when you get to this big, most of the stuff that happens throughout the year, you're talking with the accountant, you're preparing stuff in the office. It's not as if you need to meet with them monthly.
No, I think we've scheduled, and we help clients like this for many years. We would have, say, 2 formal meetings a year, and after a couple of years, even then, we're pretty happy how things are going. But I would be doing work on their behalf at least monthly.
Yeah.
Either tweaking or checking things behind the scenes, corresponding with their accountant. Hey, it's tax time. Can you send us this? Vice versa. Hey, we'll check your portfolio. Yeah. This bit's done really well. We want to try and tweak that a little bit. Is it the same amount of work every month? No. Some months there's a lot more work and some months there's a lot less work. But to have an agreement, they know what they're paying. It's not an hourly rate. It's not a percentage or a commission directly. And that just comes out every month. In this case, we're paying it out of their investment accounts, just so it's one statement for the account at the end of the year.
Yeah, it's just caught.
But some clients pay it directly. Some people pay it annually in advance, just so they know it's paid for the year, that kind of thing.
And the whole thing with ongoing advice fees, if you're paying it, you need to be getting value. If you're not getting value, number one, they might not be providing any value. Number two, the perception of value might not be reconciling with what they're actually doing, what you're paying and what you perceive as value. But number three, there isn't a three, but you don't have to do any ongoing fees. You don't have to pay a financial advisor for advice. You don't have to do anything. But in this instance, if you've got a high net worth, if you've got moving parts, you get what you pay for in terms of fees.
Yeah, our fee, and as you mentioned, it's going to be different for different people. There's an element of what is your complexity, how many moving parts you've got, and there's an element of are we helping you look after 1 million, 2 million, 10 million, 50 million?
Yeah.
And they're
because rule of thumb, more money equals more complexity.
Yes.
As a rule of thumb.
Yeah. And connecting to more value in terms of getting the strategies right as well.
Yeah.
But yeah, I haven't done the maths, but it's below 1%. It's above 0.5% of their 4.5. It's probably 0.7, 0.6.
You don't charge a percentage, but you can tie it back if you want.
Yeah. Would we charge that fee to someone with 500,000 industry fund? No.
I thought you would.
No, there wouldn't be much left in the industry fund after a couple of years.
It wouldn't be a client for long.
Vice versa. Someone knocks on the door with 200 million, they're going to be paying more than that fee as well. So it needs to be proportional to the complexity of some situation, but also proportional to the value they're getting. And sometimes that value is in the eye of the beholder.
And the value, like we touched on last episode, you're going to bed at night knowing that you're optimizing every crack in the pavement of your financial life.
There is no way that they knew that this is what their retirement could or would look like when they accepted to sell the business for that price. They thought, how much tax are we going to be paying? What's this going to look like? And what do we do with the cash?
If only we could just turn back time and restructure everything.
Yeah, we could have done things different. Started with $4 million in super rather than have to spend 10 years to get there.
Yeah.
But very happy, obviously, in that respect. So
you just got to play the cards as they land. Look,
maximise tomorrow. We can't change your past, but we can maximise tomorrow.
Thank you.
Yeah,
are you talking about my life or this client?
Just generally, big picture, yeah.
Hey, we're going to do an episode in the coming future of how Martin has managed a high net worth couple that have come into over $25-30 million that were PA Powerball win, basically.
Yeah.
Martin did their plan and the strategy, and we'll unpack it in the coming months when Martin's in Newcastle next.
Yeah.
We'll do that as a bit of an under the hood where they've had money come in, hasn't had the company structure, and just how it's been set up.
Yeah, exactly.
So, hey, if you found value in this episode, can you send it to a friend or family member who might be a business owner? Because there will be some things here. If the numbers aren't the same, the concepts will be very similar. Please forward it to a friend or family member. If you're watching us on YouTube, hello, look into that camera, Martin, and say hi.
Hello.
Thanks for giving us a like and a comment. It really helps. And we just want to always try and be real and be normal. And we will see you next time. My name is Glen James. You're listening to Retire Right.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.